Day trading is the one that is most popular among all the communities. You see all these fake Lambos, these fake houses, all that stuff. What is up, guys, and welcome to another episode of the Fit to Flourish podcast. And this is a continuation of the trading series, the Crash Course on Trading. All my socials are linked below, as well as the Crash Course Trading course if you wanted to purchase, or just tune into my YouTube for free, where I break down the entire course from A to Z, making your trading E to Z easy. All right, guys, so today we're going to be talking about the different styles of trading. There's a couple different styles of trading. Number one being the most common, which is really investing. So investing is a long-term style of trading where you put your money at risk to get a return, and typically you leave your money in the investment for over a year, and then that gets some tax benefits. And then there's another style of trading called swing trading, and that's basically where you buy and you sell securities after you hold them. You buy it, you hold the position for 2 or more days, and then you sell it after about 2 or more days. Sometimes it could be weeks at a time. Day trading is the one that is most popular among all the communities. You see all these fake Lambos, these fake houses, all that stuff. And when you see that, you know that it's day trading. So day trading is buying and selling securities within one day. So you buy in that day and then you sell it within that same day. It could be minutes, hours. And then scalping is really quick trading. And that is a form of a day trade. And that's where you trade within minutes, like very short minutes, or sometimes even seconds. And often people will scalp multiple times a day. So to describe short-term investing, it's usually riskier, and it's known as trading. It requires more active investing, and then it's also taxed differently. So you get some tax penalties for participating. Short-term investing can be riskier, but it can also be more rewarding. Moving on to long-term investing, it gets taxed differently, like I said, and it refers to the buying and selling of securities that are held for more than a year. And then you need to look at less volatile stocks, so stocks that won't go up and down dramatically and just kind of be kind of crazy. You want stocks that are steadily moving to the upside, moving up. And it typically resembles investing done in things like a 401k, mixed in blended funds, things like that. So they involve larger companies, and investors can be passive when doing long-term investing. You put your money in and you don't worry about it. And there's different assets. So like equities, they refer to shares of stocks, and then options, which are a derivative of a stock. So it's like buying insurance on a stock. And then you have future contracts. All right, so stay tuned for the next video. We're going to be talking about the trading platforms, where you actually place trades, what a broker is, and then where to chart. So we're going to get into the nitty gritty of trading on the next video. Thanks so much for tuning in to the Fit to Flourish podcast. Peace. Morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance,